everyone. Welcome to today's edition of The Final Bar. Today, we're going to talk market recovery. See, one day, that's all we needed. We're going to talk about this bounce we had off of the lows yesterday, certainly finishing the day into strength. What does this mean relative to the big picture? We're going to try to get to all those questions. Also, we're going to dig deep into the consumer staples sector, a sector that should be doing well in a market recovery period, market struggling period. Also, a deeper look at the bond markets. Ladies and gentlemen, this is The Final Bar. Hello, everyone. Happy Tuesday afternoon. Thanks for joining us today on The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining me every weekday after the close to debrief on today's price action from a technical perspective, connect the short-term movements of today with the long-term trends that we're seeing. And this week, it's all about market sell-off into market recovery. One day makes such a huge difference. And today, midday felt like we were going to weaken right into the afternoon session, right into the lows, and all of a sudden we turn and we see accumulation right into the close, accelerating with the S&P up almost 5% today. So we're going to dig into the market movements today. And again, the long-term picture is what we're going to try to pay attention to. How does this week, last week, fit into the big picture? We looked at a lot of that yesterday. Today, I think, fills in a little bit of the answer about where we're going to go next, and we'll dig into under the hood as much as we can. Now, coming up, we have a lot of really good guests and specials here to help us understand the market environment and plan appropriately. Tomorrow, I have Aaron Swenlin, a name and a face that's probably familiar to many of you, and then Julius de Kempener on March 12th, talking about sector rotation. On Monday, for Behind the Charts, we'll feature a conversation with Jeff Hughes. Jeff is a longtime institutional investor and analyst. And runs his own research service out of the Minneapolis area. Then Tim Tashler from the Top Advisors Corner on StockCharts.com. Then David Auerbach on March 18th. David's a REIT specialist, so digging into real estate. So some really good content coming up. Our goal is to bring in some great guests and help us piece together the themes and the ideas we should be aware of. Let's get right into the market recap for today. So, it's the tale of 2 days. I feel like with yesterday's sell-off going into today's recovery move. You saw the gap up at the open, the sell-off to find a low around 11:30 Eastern, and then from there it really was sort of off to the races. And the last couple hours really finished strong, which again, the last 30 minutes tends to be that institutional influx. Where are they making bets? Are they accumulating or distributing? And today it certainly felt more on the accumulation side. That rally going into the last couple hours put the S&P up almost 5% today. That's coming off of one of the worst days in a long while yesterday. So again, we're still not where we were at the beginning of the day yesterday, but certainly made up a lot of lost ground. Mid caps up a little less, under 4%, and then small caps up the least, 2.9%. So again, we have this sort of familiar theme that we've learned, which is the market going up, but it's led by mega caps. It's led by some of the bigger growth names in technology, especially. And some of the other sectors, consumer and elsewhere. Small caps, mid caps are sort of the groups left behind, apparently, right? With all these uptrends. That's in general, that's sort of unusual, right? We would expect the smaller cap names to be doing better in a recovery sort of period. So again, what this sort of tells me, it sort of plays into the dead cat bounce theory that we had a big sell-off yesterday. It would be incredibly unlikely, although possible certainly, that we would just rally and recover right from here. I would say fair to expect at least a retest of yesterday's lows, if not a push lower, even later this week to sort of, at the very least, digest the sell-off that we had yesterday. I don't think that we can say that it's anywhere near in the clear. The VIX now down below 50, but still very elevated relative to any historical period you're looking at. And as we looked at yesterday, it's lining up very much with the 2008, 2009 bear market period. Let's look at a daily chart of the S&P, and we'll get back to look at our market dashboard, see some of the things that emerge from our review there. So it might be a little hard to see today's candle, but I did want to bring in the longer term perspective just to show how not necessarily symmetrical, but how reasonable some of these pullback levels have been. So after we have this nice rally, we peak out the second, third week in February, we sell off. I have a lot of lines on here, so forgive me for that. I'll try to focus you on a couple areas, and they're the shaded areas here. So that first big sell-off took us down about 16% from the highs. That got us down to this first major support range. This was from the lows from last summer, last August and last October. Then yesterday, when we sold off, finished more toward the lows, we were right at the 61.8% retracement level of this overall move from 2018 to 2020. This also lines up from the lows from last March and the lows from last June. So bottoming out around this level, at the very least, a short-term pullback makes a ton of sense from a technical perspective. You'll also notice what's happened, again, if this has a little bit of staying power and we stay up in this sort of range, we've got a bullish divergence here with price going to severe lower lows, RSI going to higher lows. And again, that in general suggests, at the very least, a short-term bottom, a short-term rally. So again, today's action sort of makes sense. And the fact that we closed right at that 61.8% retracement level lining with support. As I mentioned yesterday, I think that's a real clear line in the sand. And as long as we remain above 2,700, I think the downside would be limited in terms of the overall processing of this. It's going to be more of a backing and filling type of correction. But if we break below there, I think you have to start looking at much deeper lows. Something like 2350 would make sense there. So today's bounce makes a ton of technical sense. What does it actually mean for the big picture? Well, let's look at some of the sector and thematic moves that we saw. So tech number one, up almost 7% today, and a lot of that really came with that push at the end of the day. Financials number two, up almost 6%. And financials were, as I was thinking of what sector to do a deep dive in, I was sort of tossed between consumer staples and financials. The problem I had with financials was it was pretty much across the board. It's a very homogenous sector with everything getting beaten down. And it's not just the banks, it's the regional banks, it's insurance, it's sort of everything with some, very rare exceptions. So it wasn't super exciting to dive very deep into that, but it's recovered very well today. On the downside, we have sort of the traditional defensive plays of utilities and consumer staples. And as I mentioned, we're going to dig into consumer staples a little bit further. Healthcare, also one of the lowest three sectors. And one of the 3 and 3 today is actually the biotech sector. It's actually a really compelling chart at a really clear level. Today's bounce, even though it wasn't one of the leading groups, biotech's actually, set in potentially an attractive, a significant low with the last couple of days. In terms of the overall movements, this is a big recovery from the oil commodity-oriented markets, something like Russia, Brazil, Australia. Those are sort of the three that usually come to mind when you think about what markets are going to be most exposed to oil prices. All of them up 8 to 10% today, followed by the S&P. The rest of the global markets were after that. You had some big moves with a number of sectors. And again, if you look at the themes from today, it was a lot of things that should be beaten down based on the coronavirus scare and potential, rollout of more restrictive travel and things like that over the coming weeks and coming months. But today was all about a recovery in those exact groups. So things like gambling, transportation related things, and then also, as I mentioned, things like asset managers, banks within the financial sector. Home improvement retailers, also one of the better groups. And again, some of these groups are coming out of very beaten down points. So this is home improvement retailers, coming off of a real significant sell-off, but holding up pretty well. Transportation services, again, in terms of the overall chart, not super attractive of a group relative to some of the other ones that have held up much better. But I did want to point out a lot of these groups, I think, are at really key levels. I would caution you again it's very easy in this sort of environment to extend what happens on one day and think of that as the new trend, right? So we've been sold off. We go to new closing lows. Okay, all of a sudden we're back to, above yesterday's low. That's great. Probably going to go up from here. And that certainly could happen. I'm not saying it can't happen, but again, in general, what we have to remember is we've now put in a pattern of lower highs and lower lows. So I'd caution you to be a little cautious about jumping into some of these groups that have rallied so quickly. A lot of that is sort of a reaction, usually a reaction to the severe sell-off that we had, unless a real emerging great theme. It's interesting to note, though, home improvement retail is on a relative basis, making a nice 3-month relative high today, really testing those. And, again, it's not just been in the last couple of days. It's actually been emerging for about 6 weeks as it's sold off a lot less than some of the other groups within the equity space. So potentially an interesting one there. I, as always, want to look at some of the stocks that make up those groups. Only 2 groups out of the 100-odd Dow industry groups that we track And it's ones that you probably are not familiar with: marine transportation, which was when industrials, and then mortgage finance names right there. I did want to finish off just looking at the Mindful Investor chart list, Mindful Investor Live chart list. And again, if you don't have access to this, you can copy it right to your login. Just go to my blog, The Mindful Investor, and you'll see a link for the chart list right at the top of the screen. Just click it, save it to your login. So this is looking at breadth in the form of new highs and new lows. At the bottom panel, it's for the S&P 500. And I just wanted to point out, this is not updated for today. This is as of yesterday's sell-off, but we had 40% of the S&P making a new low yesterday, which is pretty extreme. It rarely gets that low. The last time I got that low was the market bottom in 2018. Little different configuration here, though, because what you had there at the end of 2018 was that initial sell-off down through the 200-day recovery rally, and then the deep sell-off into an extreme sort of breadth blowout. What we saw here is actually we've had the extreme negative breadth right in that first real initial push down here, unless you think of it as a little compressed multi-move, which I really wouldn't. I think this is one big sort of distribution phase. And so I feel it feels very different than the end of 2018. I don't think we can necessarily use that as a playbook, but I like seeing the fact that the breadth measure is in line with some of those severe negative patterns. That sort of makes sense to me. That's our recap for today, our market recap for a bullish Tuesday within a bearish overall cyclical trend now, I think. I want to move on to our next segment, doing a deep dive into the consumer staples sector. So what we do with the sector deep dive is occasionally like to take a step back, look at one sector in particular, sort of dig into some of the themes, the groups, the patterns that make up that sector, because I think a lot of investors get caught up with the broad equity market, the S&P 500 or New York Composite or whatever it is. Then you think about sector rotation, you think about offense versus defense, and then you kind of go on to something else. And I think you're missing a really interesting component, which is when you see sector leadership or sector laggardship, there are themes. There are groups within those sectors that are leading the sector higher, and other ones that are a drag on the sector relative performance-wise. And I think looking at the industries within each sector can be really, really helpful, can help you uncover some of the ideas, some of the themes that you may not get just from looking at some individual stock charts. So we're going to start with the relative rotation graph. And as always, if you're not familiar with this methodology, we don't have time to go through it in too much detail. Go to our YouTube channel, look up Julius DeKempener's videos. He does such a great job explaining the methodology and how to think of it in terms of visualizing rotation. But what we're looking at here are the 11 S&P sectors. This is a weekly view, so I like to look a little more long-term. And what I'm interested in here, what I'm noticing is a couple things. Number one, technology has been, certainly the leadership. It's been the strongest sector. The fact that it's furthest to the right represents the strongest relative strength profile of any of the sectors. But what you really want to look for are the things that are moving northeast and that are moving southwest. Those are the real stories that you can uncover in terms of relative rotation. Utilities have rotated in very much a position of strength. And again, some of the few stocks making some new highs recently have been in the utility space. And after that, you see real estate, another sort of traditionally defensive group. And then you have the consumer sectors kind of lined up together, actually moving up in sync. Consumer discretionary here and consumer staples here. So what I want to do is focus on one of these sectors that was really in an improving phase. And what's interesting is if you rewind a little bit, when the market was going up, you can see consumer staples down here in the lower left in the lagging quadrant had rotated down this way. But as the market accelerated into the peak, you can see that staples actually started to participate. And again, this is not based on absolute prices. This is based on relative movements. So it's based on what's performing relative to other things. Then you can see as the market sold off, you can see staples have accelerated northeast, heading toward the leading quadrant. And I would assume that they achieve that in the next couple of weeks, assuming that we see a similar trajectory to what we've looked at. So what do we see if we look at the consumer staples group? So it's comprised of about 10 different groups, and you can see them listed here. I'm sorting them in the form of the scooter ranking. And if you're not familiar with this page, go to Charts and Tools and go to the tab called Industry Summary, and you're going to get this list of each sector and then the groups that comprise those sectors. And sorry, if we go up here to consumer staples, I'm sorting them based on the StockCharts technical rating. The higher the number, the stronger the trend. And I can see the number one group out of those 10 has been food retailers and wholesalers. We talked about this as one of our 3 and 3 yesterday, if I remember right. But this is a group that is sort of the flight to safety in terms of people, needing goods to survive some sort of social distancing. So things like Kroger, other supermarkets are going to be in here. So imagine people running to the grocery store trying to stock up. These are the stocks that are going to do pretty well in that environment. KR Kroger is the biggest stock in that group. And again, I love charts like this, where if you didn't know that the market overall had sold off aggressively, you wouldn't necessarily see it from this chart. The chart looks like it's in a pretty consistent, solid uptrend, higher highs, higher lows. The relative strength has accelerated. It's been overbought, but not too overbought, and it's pulled back a little bit. Seems like a really attractive chart. Again, if I had a portfolio of charts that looked like that, I'd probably feel pretty good right about now with how much so many stocks have been selling off so aggressively. Going back to this list, and again, I'm handpicking just a couple charts with each of these groups, one or two. So I'd encourage you to follow through with this on your own time when you can. Dig into some of the other names and groups that you might want to look at. The second most attractive group, and these are both within the top 10% of Dow industry groups, is non-durable household products. If we look at that, these are things like Clorox, these are cleaning supplies, Kimberly-Clark. Those are some of the names you might. Church & Dwight is another one you might be familiar with. Clorox has been sort of similar to Kroger. It's one of those charts that doesn't look like anything bad has happened with the market. It looks sort of long and strong up and to the right. Pulled back a little bit today, as it's flat on a day when most things are up. But overall, the trend has been very positive. Also wanted to point out something like Kimberly-Clark. Again, something that's just coming off, real strong highs, less extended, but overall, excuse me, in a pretty decent uptrend. This one's testing pretty significant resistance around the 148 level. So you'd want to see if it's able to build above there with any sort of momentum to sort of think of an all clear along those ways. The things that have been dragging in terms of any surprises, I'm a little surprised to see distillers, vintners, brewers doing less good. I'm going to totally butcher a quote, but I remember this sounds like a Richard Russell quote or something like that. One of that era of technical analysts talk about in a downtrend, you want to do things you smoke, you drink, those sorts of stocks, because those habits don't tend to die in a down tape. But if you look at the charts of some of the brewers, they're really not that attractive. So that idea of going to those sorts of really staple type of names has not been working. And so I would encourage you, again, one of the worst things you can do is say the market's doing this, get it right, but then make the wrong bets because you're betting on a group that you think probably should do well. Make sure you look at the relative strength. You'll see that something like Molson Coors has actually been in a pretty good downtrend, and on a relative basis has really struggled. I think a lot of the brewers are in that same kind of position. They're not holding up well with this sort of environment. So within staples, again, that is a quick look at some of the different groups on here. I'd encourage you to look at the industry summary page, look at some of the other ones we weren't able to get to. And again, you're going to find, especially in those top two, food retailers, non-durable household products, even tobacco, there's some charts that potentially are compelling ones that are starting to really outperform in a down tape. We need to take a quick commercial break. We'll be back with the segment Clipping Coupons, looking at the fixed income markets. See you in a minute. Hello, everyone. Welcome back to our show, The Final Bar. Thanks, as always, for joining us every weekday after the close to look at some charts together, try to make sense of this market environment. Please keep your questions coming. We had a mailbag segment yesterday, which was a lot of fun answering some of your questions about navigating this market environment. Shoot me an email. thefinalbar@stockcharts.com is the best way to get your questions and your feedback to us. Or during the show, just go to the Q&A window on the StockCharts TV page, and you can put in a comment. We'll capture all those. And later this week, we'll do another mailbag segment. We'd love to answer your question, help you, again, think about technical analysis, think about the markets, think about a particular group or stock. Anything is fair game. Just let us know. Our next segment is called Clipping Coupons. My producer, Gretchen, and I were talking about this show and what we could do with it. We thought from an educational perspective, there are a lot of times when I think on our platform, we find a lot of investors are very familiar with equities, quite familiar with ETFs, much less familiar with some of the other asset classes, commodities, currencies, fixed income, and what we want to do, options. And what we wanted to do was try to dig into those one at a time and really help you understand, focus on those, and think about how they relate to your equity bets in your portfolio. So what we're going to do is talk during this segment, clipping coupons, I just want to stay a little big picture and think about what the bond markets have done. We're going to start with the chart of the TLT, which is the long bond ETF, the Treasury bond ETF. I want to talk about the patterns we're seeing there. Then we're going to look at stocks versus bonds and how they relate. Then we're going to look at some of the other benchmarks in the fixed income industry, see if there are any additional inputs, additional color we can identify. So this is the TLT. It's one of the most liquid ways that I find investors access bond prices, especially financial advisors, because it's relatively low cost, easy way to get exposure to a fairly conservative part of the markets. The TLT overall has been in a pretty consistent uptrend, and coming out of this what's a descending triangle pattern from the fourth quarter of last year, resolving higher in January, breaking to new price highs here last month. Overall has been strong. What happened though with bond prices, they accelerated to the upside. So just as stocks and bonds around here, we're all both doing well, right? So stocks doing well, bonds doing well, everything's happy. And all of a sudden, I remember looking at that chart and thinking some of this has to become disconnected. These things cannot all move up at once. They tend to be a little more differentiated. Sure enough, as we know, stocks have sold off, bonds have remained in a position of strength. And as stocks have returned to the downside, there's been a huge flight to safety going to the bond markets, and especially to treasuries, the most conservative part of it. So the TLT actually gapped up the last couple days before today. Friday into yesterday's session went up. Yesterday was interesting because it closed more down toward the lows. I'm going to zoom in just a little bit so we can see that in a little more detail. So here we can see the sell-off yesterday, again, up from the previous day, but closing more toward the lows of the day. And we saw follow through with that today, closing again more toward the low. So bond prices have really been in more of a pullback mode for the last day or two. What's interesting is they had most recently been extremely overbought. And what that means in general is when a market goes really up, when it goes up a lot with an RSI above 80, that usually suggests, in my opinion, it's extremely overbought, meaning you may have a minor pullback, that's fair, but you're going to have at least one more push higher because the momentum is so strong, probably going to have at least one more leg higher before it can resolve because of that upward momentum. So based on that, this pullback to me seems relatively viable only because you'd expect at least one more move higher for the RSI to get back in the overbought range, for the price to go back up at least one more time. And then you find out if it's a continuation and we go further upside, if that any sort of bearish divergence is negated, or do we have a lower peak in RSI suggesting that bearish divergence, a lessening of momentum, a rotation away from bonds. So overall, my base case on the chart of the TLT is it's been a pullback that makes sense, especially on a day when stocks rallied so much. Expect another move higher, and then we'll have to see what happens there, see where that move is relative to yesterday. But by any measure, it's become certainly more vertical than not. So two ways that I would think of the relative movement in the TLT versus your stock bet. So two things I will show you. Number one is the stock to bond ratio. So if I go here, Mindful Investor Live chart list, here we go. I think on page 2, I have the stock bond ratio here. So what we're looking at now is just a simple ratio of the stock market to the bond market, stock prices versus bond prices, the spiders versus the TLT. And as you can see, that ratio overall went down significantly in the last couple of weeks, right? And this is obviously during the sell-off in stocks, the rally in bonds. That's what's going to make this go to an extremely low level. This is just today's recovery, that move with bonds coming down, stocks coming up. But I would point out overall, the trend is still pretty negative, or not negative, but favoring bonds over stocks over that period. So until we see some material change in that ratio, overall, it's still suggesting in my read that you're leaning more toward bonds than stocks at this point, until you again see further of a development of any sort of uptrend. Another way to look at this, though, I was thinking about it, was looking at the yield in stocks versus the yield in bonds. So here in green, we have the dividend yield on the S&P 500. If you own the S&P, what's the yield you can expect? And it's about 2%. And that's pretty consistent. If you look, there's a spike there in the 08-09 low, and the market was down so much and dividends sort of stayed where they were, that you made a lot more. But in general, you yield about 2%. That's fair, 175 to 2%. Here's the yield on the 10-year Treasury bond. You can see overall, obviously, it's been in a long-term downtrend, right? Weaker yield, stronger bond prices, really at an all-time low here of 50 basis points. So if you look at the difference between these two, this is telling you from a yield perspective, should I be owning stocks and gathering that income or owning bonds and gathering the coupon payments. And the ratio, as you can see, has just broken above that high from 2009. So it's overall saying this is the best time to be owning stocks relative to bonds because you just get paid much more. Excuse me. And that's in a relatively, reasonably yielding S&P. If you look at utilities or a higher dividend paying group, you're going to do much better than 2%, obviously. But overall, it shows you why stocks can be a compelling alternative to bonds if you're looking for income right now. So besides the TLT, what else can we do? I'll just show you a couple things very quickly. The next thing I would do is LQD. This is a corporate bond ETF. So just like the TLT is showing us bond prices, and it's particularly looking at treasury bonds, the LQD is looking at corporate bonds. So this is looking a little bit more at companies issuing debt. You can see this is pulled back a little more. The RSI just below 40. So it'll be interesting to see if it holds here, suggesting there's some stability, but it's come off a lot as equities have recovered there in the last day. You combine those two, the TLT treasuries, the LQD corporate bonds, and you make the aggregate index AGG, which is a proxy for overall bonds. And I want to finish with this, just showing you this has also been extremely overbought, similar to what you saw here at the market low in December. So, stocks had bottomed out. Bonds in the form of the AG, extremely overbought, suggested much further upside. And that's sort of what we're seeing here. So based on all of that, I think the bond markets overall still look pretty compelling. It's totally reasonable to have a pullback after the extreme overbought readings. But overall, all else being equal, suggest further upside in bonds. And ladies and gentlemen, we need to wrap the show going to the 3 in 3. So at the end of every show, 3 charts in 3 minutes. Here we go. Chart number 1 is gold. We didn't talk a lot about commodities in this show. We've been hitting some of the other asset classes, but I would point out it has not gone anywhere. And I mean that's a tongue-in-cheek way of saying, number one, it's moved a lot less than all the other asset classes. They've been sort of fluctuating dramatically high volatility. Gold's been in a relatively less volatile sort of environment. The RSI sort of hovering in that bullish range above 40, below 80, and overall just fine. It's pulled back a bit in the last day or two, but overall still in a position of strength. And I maintain the fact that I think gold as a long-term play still seems really, really attractive, especially as stocks I think are going to have to, at the very least, back and fill and digest the recent moves in the last couple of weeks. Chart number 2 is healthcare. This is a chart of the XLV. We did a deep dive into staples, and again, when I want to do a deep dive, I spend way too much time debating which sector I really want to get into because they're all so interesting, and there's some interesting themes in there. And healthcare was one of the ones I looked at today because I think it's at a really important part. You saw how it had outperformed in 2018 going into the market low, had underperformed coming out of those lows, but then it's basically been a market performer for the last 12 to 15 months. That all changed about a month ago as healthcare has held up much, much better than the rest of the market. So relatively has gone up to a new 12-month plus relative high. What's interesting with the XLV, it is back down to trendline support, taking the market low from December 2019, connecting it to the low in October. You line that up and it lines up pretty well with the lows we've seen in the last couple of weeks. So as long as the XLV remains above there, we're in pretty good shape. If it starts to break down below there and especially breaks below that key 90 level, I would be concerned about healthcare and be thinking about other sector bets to make in any sort of rotation strategy. Finally, we have biotechs. I mentioned earlier, I think biotechs are an interesting group to pay attention to. You can see taking the low from December 18, taking the high from April of 19, we can see, excuse me, these retracement levels have actually played out really well. We tested the 61.8% level a number of times here last summer, broke down through it last October, but came right back. The highs were retested a number of times at the end of last year into this year. Now we're back down in this range. So I think this 4,400 level on the biotech index is going to be a really interesting one. And you can see that the RSI's hovered above that oversold region. Also, relatively speaking, potentially starting to break out. So I would be keeping an eye on biotech as a poster child for what the broader equity health might be. And ladies and gentlemen, that's our show for Tuesday afternoon. Thank you so much for joining us every day after the close. You can see all of our previous shows on our YouTube channel. Just search for StockCharts and you'll see what we're doing. Thanks again for sending all your questions to the final bar at StockCharts.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a good night.